Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for September 10th, 2016. The market moved up into bullish normal conditions. On an annual basis using weekly RSI 14, we are in the middle of neutral at 55 out of 100. On the 10-day NDX, we are well oversold at 1 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average has pulled back to white bullish at 4.26%. The slope of the 50 is white bullish, positive 0.57. ADX has crossed above 15, but is still neutral with respect to strength of trend. The risk index is the 30-period moving average of the VIX divided by the 10. The boundary between risk on and risk off is 1.0. Current reading is at 0.934. We are into risk off conditions. This is a 90-day histogram of that indicator. You can see how we've gone from minus 2 sigma to plus 3 sigma back to the zero line, and then for the last 10 days have been in risk off, which I feel like once again gives us plenty of warning for Friday's sharp counter reaction, and made possible some nice intraday trades on the volatility shock. This is the blended monthly rebalancing current holdings. Next reevaluation is due on or about 1 October. These are the leading symbols based on Friday's close. In ETF2, the theoretical exposure remains at 100%, with the model portfolio at 100%. I would be looking to preserve a portion of those profits from the outsized gains we've experienced there, and be ready for increased volatility as we approach elections. Just a quick look at the blended monthly rebalancing portfolios. Here's the ETF 13. We've real estate, treasuries, and Australia have moved into the cash position as they've gone under their four-month moving average. The leading ETFs took the biggest hits this week. So Latin America, emerging markets, Asia less Japan. About half of the ETF 32 is on cash signal now. And again, Brazil, one of the big losers from this week, had been one of the biggest gainers over the last month. So I think that's people moving to preserve profits, plus the inherent volatility of the international markets. ETF Max is a look at the top 50 ETFs in the 1000 ETF database. Key leaders in the precious metals took some hits this week. Silver, gold juniors. Saw some gains in Russia, so that'd be energy, Japanese bonds, natural gas, China real estate, nickel. In the S&P 500, some things to look into in the energy sector: Spectre Energy, Chesapeake Energy, and some gains given up here in NVIDIA and some of the other techs. I'll be stalking Devon Energy. It had a negative week, but it's been having a great 3 and 6 month performance. So I'll be looking for continued strength in energy being manifested in Devon. The 40 days of sideways quiet channel looking patterns here cracked significantly on Friday. Next blasted through the 215. Next stop is 210, which would be the top of the dragon hump here. Wouldn't surprise me to see it get all the way back into 207. 205 is the firewall. That's the 200-day moving average. It's the double bottom and the dragon hump. This is the subject of a lot of discussions this weekend. And so I'm expecting some more volatility, and we know what to do on that, is to follow the flow intraday and then use that to build positions that we would consider holding overnight with markets money, but otherwise I'm going to maintain my short-term time frame and follow the currents and protect capital. In the ETF2 regional report, everything remains above its 4-month moving average. EFA at 48 has now moved ahead of the U.S., so that's the first time in about 4 months we've been able to say that. And then inside the U.S., it's U.S. small caps, then tech, then mids, then large caps. Two strongest sectors, Latin America and emerging markets still, although they suffered the most in this past week because of volatility. This could be a changing of the guard as we get closer to November. In the world market model, small caps are above average, as is growth, but otherwise U.S. Below average. China, Hong Kong above average. Latin America and Brazil still overall the strongest long-term sectors. But again, we're at a potential tipping point here. All of Europe below average with the exception of value, Germany and Austria. ETF top 30, I see China, green and white, so that's beginning to start to make a move. Hong Kong, oil and gas exploration is part of that energy complex. Biotechs in India. In the Dow, Caterpillar's starting to give up some gains here with the white and then green, so it's getting weaker. And you can see the U.S. large caps are tipping towards the bottom of the stack now. We used to, 6 months ago, this was mostly green and white in the strength, and now it's mostly red and yellow. So a steady rotation away from the conservative large caps. Shifting to the daily report, just about everything fired on the overreaction and channeling system, so this is a market condition rather than a sector rotation. And so I would pick the two that I like the most, and then I would start them as day trades and then try to make money intraday to be used as markets money for overnight exposure. And I would be looking at Latin America and emerging markets, and then the U.S. small caps as the most volatile and most favorable trading vehicles. Just about everything, as I said, is in the channeling and overreaction. We look at the ETF 30 and the Dow 30. Basic materials and financials, United Tech and Apple firing on the 5DD, Intel with a long signal on the triple screen. I would wait to see some evidence of mechanical entry before I took that one. Auto framer, lots to choose from as retests of the 10-day high. Oh, you can see the volatility spike that just started Friday. And in the ADX, it's bears in charge as the trendiness begins to strengthen. So that's more trouble ahead. Lots of channeling and overreactions. Lots of symbols washed out on the RSI2. If you're looking for the ones that resisted the sell-off the most, you'd look for the green, like United Health, Merck, Johnson & Johnson, Morgan, and McDonald's. If you wanted to look for increased volatility, either as more sell-off or perhaps as a rebound from overreaction, you'd look at these red symbols, United Tech, Boeing, etc. Same story in the ETF 30, most everything on a channeling and overreaction. You got a couple 5DDs, just a handful of auto framers. And because of the size of the move, and being such outliers, XIV and VXX just dominate. I mean, it's 16% move one day. Welcome to the world of the volatility trader. Some auto framer candidates that test out nicely, and the regression line fractal framework. These in the green on the top shelf are the deepest value plays and how many ATRs below their 270 regression line they are. And then on the bottom shelf in the red are the ones that may be the most overheated. These are the ones that are the most numbers of their own ATRs above their RL 270. Daily squeezes, there's just a handful. In the market mosaic, we'll just flash through some of these. Something I just want to highlight here on the signal to noise ratio. The way you can use this is a measure of the amount of signal or the amount of movement intraday it experiences. So the ones that are in the green are the ones that have the largest real bodies relative to the rest of their daily move. And so when you see things like, I'll zoom that in for you in the green. Emerging markets, Asia less Japan, oil, Latin America, and Brazil, metals and mining, and energy. These are all things that have large directional moves intraday, meaning that they're well suited for things like hybrid frogs, the owl patterns, pocket trading, because in the case of emerging markets, almost 70% of its move on average has been real body. So it's been very directional intraday. That doesn't always correlate to quality swing trading moves, day over day with, long enduring swings. But in terms of the intraday trendability, that's a pretty good measure. Then the ones that chop around a lot would be the ones down here in the red. And so these are ones intraday that we are more likely to cash them when we get them. So it makes a move, and then there's a lot of backing and filling. So things like the Dow, Microsoft, the S&P, Coca-Cola. These are ones that when you get an intraday move and you have money in hand and it's starting to stall, you'd be well advised to go ahead and cash it. So just to compare GE with only 0.3 of his daily candle on average being real body, it says it does not have much consistent follow through intraday. There's a lot of backing and filling. So that's one of the ways you can use this to gain deeper insights into your trading targets intraday. This is shows the magnitude of that breakdown through the river. This was a nice Z3P breakdown. And again, for support level around here, around 210, and then really holding strong at 205 is kind of the gateway. If it breaks through here, then all bets are off, and even that's would be a remarkable move in the indexes. But we've seen those kind of moves before. Here's one, here's another one, here's another one. So just 4 times in the last 6 months we've seen moves of that size. All of them at the turning point have turned out to be reasonable opportunities to buy quality on sale, and so we want to not get overly fixated looking at what's on fire, but recognizing that at some point the fire's over, and new frames of reference have got to be established. That's the beauty of statistics and statistical descriptions. It gives you the ability to be dispassionate and to use math to frame your decisions rather than emotions. So that's everything I want to cover. I'll be recording some audio for the strategy workshop. Our second follow-up will be looking at the 10 top ideas that came out of that workshop and summarizing the key learning points as a review for all the people that attended. We'll be doing another one of those in Raleigh in December, and I think we'll be recording that one for the creation of a home study product as well. So Thanks for your kind attention, and we'll see you in the chat room. Take good care. Keep your risk measured and your powder dry.